Today we discuss the forces which will drive change in banking. Hello again, I'm Martin North, the Principal of Digital Finance Analytics. Today we discuss more important data which reconfirms the views that property prices will fall, lending will tighten, and banks will be forced to change. First, the good people at UBS have published further analysis of the mortgage market, arguing that the Royal Commission outcomes are likely to drive a further material tightening in mortgage underwriting. As a result, they think households' borrowing power could drop by 35%, mainly thanks to changes of the analysis of expenses as the HEM benchmark drives. This, of course, was criticised in the recent discussions at the Royal Commission. Their starting point assumes a family of four has living expenses equal to the HEM basic benchmark of $32,400 per annum, which is, by the way, less than the old age pension. This is broadly consistent with the major banks' lending practices through 2017. As a result, the borrowing limits provided by the bank's home loan calculators fell by 35%. The loan-to-income ratio fell from 5 to 6 times to 3 to 4 times. This leads to a reduction in household credit and a further potential fall in home prices. And this plays out very similarly to the scenarios that we discussed a couple of weeks ago, exploring the outcomes from a mild correction to a crash. A 20% reduction in borrowing power has already hit, by the way, and this is before the Royal Commission revelations. Now, this will have a significant impact on the banks, but the broader economy will also be hit significantly. The other information came from Rob Sims, the chairman of ACCC today, when he spoke at the AFR Banking and Wealth Summit. And he gave a talk entitled Synchronised Swimming versus Competition in Banking. His excellent speech is actually worth reading in full, but net, the tempo for reform just got stronger still. He discussed the results of their latest investigation into mortgage pricing and also discussed the broader issues of competition versus financial stability in banking. He warned that the industry should be aware of and respond to the fact that the drive for consumers to get a better deal out of banking is shared by many beyond the ACCC. Every household in Australia, he says, is watching. He discussed the mortgage pricing findings from their recent interim report, and specifically the transparency of interest rates, the treatment of loyal customers compared to new customers, and why discounts do not indicate vigorous competition. First then, the transparency of rates. He said it is the nature of competition that similar goods can be compared. You need to be able to compare apples with apples. But it is the nature of residential and mortgage products, he said, that no two apples are alike. The headline price is a starting point, which may then vary by much as 78 or to 139 basis points below the application headline interest rate. And over the life of an average loan, and this is crucial, we're talking about discounts which amount to life-changing amounts of money for average income earners. He said, these discretionary discounts do give borrowers a better price, but easy comparison is almost impossible. Lenders determine discretionary discounts against a range of criteria, some of which are opaque to the borrower. And since the decision criteria for discretionary discounts vary across lenders, borrowers can find it difficult to determine in advance what, if any, discount they may be eligible for. And further, discretionary discounts may only be applied and known deep in the application process, and borrowers may even be required to lodge a loan application to confirm the discretionary discount available to them. And to compare one product with another, the whole process needs to be repeated each time. Borrowers essentially need to go through the time-consuming process of lodging an application with multiple lenders in order to make an informed decision. And these requirements increase the time and effort associated with obtaining accurate interest rate offers, making it difficult for borrowers to determine the range of effective interest rates available to them. And when it comes to residential mortgages, it pays to be a new customer, as discounts are a key tool used by residential mortgage lenders to secure new borrowers. And due to the difficulty of changing your existing loan, existing customers are assumed to be locked in. And for good reason. In many cases, they are. In recent years, residential mortgage lenders have been increasing the discounts offered to their new borrowers compared to the discounts offered to new borrowers in the past. And this practice has resulted in new residential mortgage borrowers often paying a lower interest rate than existing borrowers. Based on data supplied by the Big Four banks for the last 3 years, existing borrowers on standard variable interest residential mortgages were paying interest rates of up to 32 basis points higher on average than new borrowers. And on a $325,000 mortgage, 32 basis points would save approximately $1,200 a year in interest over the first year of the loan. He also specifically called out a lack of vigorous mortgage price competition between the 5 big banks, hence synchronized swimming. Indeed, he says, discounting is not synonymous with vigorous price competition. And the ACCC saw evidence of communications referring to the need to avoid disrupting mutually beneficial pricing outcomes. He also said residential mortgages and personal banking more generally make one of the strongest cases for data portability and data access by customers to overcome the inertia of changing lenders. Finally, on competition, he says that if we continue to insulate our major banks from the consequences of their poor decisions, we risk stifling the cultural change many say is needed within our major banks to put the needs of their customers first. Vigorous competition, he said, is a powerful mechanism for driving improved efficiency and also for driving improved price and service offerings to customers. It can in fact lead to better stability outcomes. And this puts the ACCC at odds with APRA, who recently once again stated their preference for financial stability over competition. And in fact, these two elements are not necessarily polar opposites. But what is clear from both these reports is that banking is in for a shake-up, and this is a good and strongly overdue thing. Now, these two sets of findings will come as no surprise if you've been following the discussions on this channel in recent weeks, because we've already been calling out the impact of home prices falling as lending standards are tightened, and the fact that even today, mortgage borrowing power has been reduced. And we've also been discussing these broader issues of competition in the finance sector and the fact that consumers are getting a poor deal. But it's nice to see both industry analysts and government agencies also beginning to sing from the same hymn sheet. It looks to me as though there will be real change in financial services in Australia, and it will benefit customers, but it means that the major banks will have a real big headache ahead as they try to change their culture, change the economics of their business, and do better for their customers. If you found this useful, please do like the post and add a comment or a question. I read them all. And if you've already subscribed, thank you. I'm really grateful for your support. And if you are yet to subscribe, please do so to receive future alerts. I'm Martin North, the Principal at Digital Finance Analytics. Many thanks for taking the time to watch.